Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. And today we're going to review some construction data because this is part of the supply and demand. So those of you watching on YouTube, we're going to share the screen here and you can kind of follow along here. But this all comes from Construct Connect. You can find them online. And this is from their spring webcast looking at the construction economy. And really the point of going through this is just kind of seeing what's going on in commercial real estate on the construction side so that we can have a better idea from an investor side of what might be going on. So some of the overview of this whole thing, big three things: the pace of growth in construction spending has begun to slow and it's been pulled down by problems in the commercial sector. Now, it's not all commercial real estate. There are certain sectors, and this we'll get into more. And number two, Architectural Billings Index, which kind of shows how much billing architects are putting out. This continues to disappoint as an indication of fewer projects in the planning phase. The institutional sector offers some opportunities, and there's hope that multifamily will begin a recovery later this year. So in looking at this, spending on construction of buildings was strong in 2023 compared to 2022 and saw big increases across the board. So part of what we're seeing in 24 is some of the things not moving forward as strong. But there were big winners from 22 to 23. We still saw increases in the amount of spending on office buildings. It was pretty similar to some of the other retail and commercial, but the big increases were in manufacturing. On the institutional side, we didn't see as big a gains in 23. We talk institutional, this is healthcare, education, religion, transportation, things like that. We're all growing, but not to the same degree as manufacturing. So spending remains strong in early 2024, but it's slowed down some. Now, to me, when I look at this, I don't see this as being all doom and gloom. This is things slowing down a little bit from what was hot in 2022, more increases in 2023, and maybe things starting to normalize here a little bit. So the bigger changes, though, is still strong growth in manufacturing with a greater than 30% change compared to 2023. Other places that are still strong is public safety, religious, and education. Big slowdowns we're seeing. One is in lodging. Office space, though, still growing, which is really interesting. So when we see this slowdown, people, if you're worried, will ask, well, what's the risk of a meltdown? Because that's probably the biggest concern. So property values have declined by 13% since 2022. Most of this is after interest rates went up and went up suddenly. Office prices, though, are down 24%. So some believe that office may be seeing some stabilization as 30% of paid work days worked remotely, almost a third. And it seems like this has stabilized. As we've talked about here before, as I talk to a lot of employers, there are some still that as long as they are having to be competitive for employees, they will continue to let them work from home because they need to attract these good employees. But if they feel like they have the leverage, they would rather have employees back in the office because they feel they're more productive and have better creativity when they're collaborating with their peers. But there are other opinions out there on that, and we'll see where this goes. From the office standpoint, office vacancy rates are almost 20%, which is an all-time high. So that's quite a bit of office space to be filled if people start coming back. And almost half of office leases signed before 2020 haven't yet expired. So these are not listed as vacant offices. Even if they're vacant, if you have a high quality, high credit tenant, they may still be paying rent on leases on office that aren't full anymore. So this could get worse for the office sector. As investors, what does this mean? Well, as we look at these loans coming due, owners are forced to refinance at higher rates or sell at lower prices. And as we're seeing now that it looks like rates are going to stay higher for longer. And I still have a problem with when people talk about rates being higher, because rates right now are pretty close to long-term averages, to long-term norms. And what we aren't seeing is super low rates. And there hasn't been a reason to go back to super low rates. And maybe the Fed now has decided that the stimulus or more stimulus from the Fed side isn't the best thing overall for the economy. And this is another one, just sorry to detour, but I had a conversation with some nurses the other day, and they were complaining about how hard it was to afford a home. And we know this is a problem. There's some data out there that says to afford the average home in America, you need to make $105,000 a year, I think it was. And the average worker makes 70. So there's a gap there, and it can't stay that way. So I understand what they're talking about, but at the same time, there's so many people out there, they look at interest rates and are like, wow, I wish interest rates would come down so that I could afford more, so I could afford one of these homes. And we don't know what would happen. If interest rates came down, we may actually see a lot of stuff flood onto the market and prices actually come down because there are more sellers, because there are a lot of people out there right now who don't want to sell because they could buy a fraction of the house they have and pay the same in mortgage because they're going to be at a significantly higher interest rate, especially if you locked in a rate down around 3%. So we don't know exactly what would happen if interest rates come down. But what we do know, and that a lot of people don't understand, that artificially low interest rates artificially drive asset prices up. And what does this do? This really benefits people who know how to make money off of low interest rates. And that's what happened. It was kind of the dream time for a lot of commercial real estate investors, especially in multifamily. But for the person trying to buy a home, it hurts them. But a lot of people don't understand how this hurts them. And that actually for the average working guy, more normalized interest rates are better than super low rates. Again, that's my opinion. I know there are people out there who are considered high-level economists who agree with me, and some who disagree. But sorry, back to this. When we go back to the offices we were talking about, so we've already hit all-time high office vacancy rates at 20%, and almost half of office leases signed before 2020 haven't expired yet. So there could be pain coming here as these loans become due. Office loan defaults is still seen as a major risk, and small and mid-sized banks hold 80% of these loans. So the question will be, as things start to happen here, is how will the Fed look at these loans if there starts to be some crisis? Will they put support behind just this sector or behind all real estate and drive rates down? Will they step in and support some of the smaller banks, or will they let smaller banks fail and just protect the bigger ones? So we don't know where this will happen, and a lot of different things could happen here. But it does say there's still a lot of risk in office. And I've looked at some office projects, and there's some great office deals starting to come around. It's taken longer than we thought, but they're starting to show up. And what do you consider a great office deal? Well, to me, the criteria for a great deal is a deal that I can buy at a price that I can lease at half the market rate and make money break even with it being 50% full. At that point, you've taken a ton of risk out of the deal. And if you can be the cheapest one in the market, it should be easy to stay half full. And maybe you can do even better and make money. And when office recovers, which I truly believe it will, these could be some of the biggest wealth building opportunities of a lifetime. So it's not that all office is bad, but one needs to be really judicious in how they look at buying office. All right. So moving beyond office, construction costs have stabilized. And this is a key point here. And we'll get into some other graphs here in a little bit. But if we look at price changes over the past year between March of 23 and March of 24, I guess we're a little bit beyond March. Biggest rise so far in the past year has been concrete. Concrete's up 6.2%. Gypsum products are up. But as far as building materials, all the other materials are down. Plastics, copper, steel, lumber have all gone down in the past year. The things that are still driving things up are wages. Construction wages, architecture and engineering services are all still up. This wage inflation or still growth of wages is part of what the Fed has kept talking about when they haven't dropped rates, because this is still part of the inflation that they're fighting. So on a construction side, where costs really shot up from 2021 through 2022, over the past year, those have gone down some, but they still are higher. And that's this next slide here. So we can see that it was really in early 21, things came off of a standard trajectory and jumped up quite a bit over the 6 months through the middle of 2021. But then they just took off really in late 2021 until like October 21 through October of 2022 and even January of 23. Input prices for building and construction went up about 40%. And anybody who is trying to build a building felt this. Since then, they've stabilized. They've come down a little bit in the last year, but have stabilized there. It was during this time that our practice was looking at, we bought an office building, we're going to remodel it and add some surgery center to it. But as we were trying to design the building, construction costs went up faster than we could get it designed and under construction. Every phase of the design, when we went back and rebid it, prices jumped up again. And it just reached a point where it was unaffordable. So now we start looking at projects, those total inputs have stabilized, which makes it a little easier for people looking to build projects to know where they're coming from. But at the same time, architecture firm billings. So this is, again, how much stuff is being designed has been going down again. It kind of dropped off the cliff during COVID, rebounded in 2021, but it's kind of been sliding downhill since the middle of 2021, which says a lot of projects aren't moving forward or just aren't even going out for bid. So this next sign, basically the assumption here is that the assumption or the analysis says the new design contracts and inquiries have flattened out and aren't likely to rebound soon. So not only have billings been drifting downwards since the middle of 21, new design contracts have drifted down at about the same rate, and inquiries about new projects have also been drifting down at the same rate. So it doesn't look like there's a lot of new stuff that's going to be in the pathway going forward. So now we're looking at what sectors are the biggest things pulling this down. And number one is multifamily has been pulling down these scores. The institutional sector looks like it's got the most upside potential right now. Multifamily, we'll get into this a little bit more. Multifamily's been in the slumps. The question now as we hit the middle of 2024 is it bottoming out and getting ready to recover? Or will we see some more trajectory downwards? There's opinions on both sides of that. It seems like a lot of people feel that multifamily may be on the rise at this point. When we look at everything else, a lot of other commercial properties that went down when rates went up have started to stabilize, except for office. The declines in office prices seem to be accelerating more. Apartment prices have been accelerating downward over the past year. But now the question is, are we hitting the bottom? The one that's kept going up through this time, though, is industrial and specifically manufacturing. So when we look at prices kind of going back for the past 15 years, all the different sectors of commercial real estate kind of trended pretty close together until about 2010. And this is where the beast or the high times of multifamily apartment investing began, when multifamily broke free from the rest of the commercial sector and went on a tear. And it went on this tear at a pretty stable trajectory over the 10 years between 2010 and 2020. And then it shot through the roof between 2020 and 2022. But that's when we saw interest rates jump. And it's the one that's taken the biggest hit. So the most dramatic declines since interest rates went up have been values of multifamily properties. The things that continued to grow, but not at the same pace through the 2010s, were mainly industrial. Like I said, industrial kept up. When interest rates hit in 2022, industrial only took a small dip, but has now begun to grow again. So it's the one sector that over the past 2 years has continued to increase in value. Retail, on the other hand, retail stayed along a pretty flat trajectory, pretty much up through 2020. It saw some uptick from 2020 to 2022, a little bit of a downtick with the interest rates, but then has held its own. And really the question there, I think, is a lot of people have not been interested in retail because to the common folks out there, still retail, they see retail being in trouble because they think everybody's shopping on Amazon all the time. And because of what was going on during that whole time from 2010 to 2020, there wasn't a whole lot of retail being built. And so right now we're looking at the lowest vacancy rates ever in retail. So that's an interesting place, but we haven't seen the huge increases in values. Does that mean that retail's laying in wait for some glory times ahead? We don't know. I like retail, and that's why. I like industrial. Manufacturing is likely to continue higher as we see the continuing onshoring, and it doesn't seem like it's been overbuilt. Office, on the other hand, office saw some continued growth in value until 2022, but has been dropping off not as fast as multifamily, but has been dropping off and looks like it will continue. Even with seeing those changes in multifamily prices, multifamily properties still top investors' preferred assets for 2024 compared to other commercial real estate. And after the last, as we were just talking about, since 2020, multifamily had been on a tear for a long time. It got a lot of press and a lot of people started working in this sector, and they haven't stopped working. They've been working really hard on selling it. You see a lot still on multifamily in social media. And a lot of people believe that the dip it's taken its full dip and will go back up again. And a lot of this is based upon housing shortage. And are there enough places for people to live? A lot of cities have been talking about it being a crisis. So we'll find out going forward here, although it's still at the top for people looking at it. And a lot of the experts feel it's hit a bottom and has some bright time ahead. It has gone down. So where we stand on multifamily, I think in the right places where there will be continued population growth, not just retirement growth, but where's the industry going? Where are the jobs growing that people will move to? And if those places are short, there'll be a need for more multifamily. So I'm not down on multifamily. And I've talked to some syndicators lately who really are starting to find some great deals that are great deals for investors. In fact, in the past week and a half, I've had a couple of conversations on deals that should exceed 20% IRRs, even if they don't do that well and could do even better than that. It'll be interesting to see because in really talking to people in the multifamily space, how they're underwriting, and a lot of them got so used to a lot of loose and wild underwriting. It's kind of hard for them to be conservative, although everybody talks about it. It really, when looking in the multifamily space, man, you gotta know some underwriting to be evaluating their underwriting and understanding what it looks like will happen here. There looks to be in a lot of areas some decrease spending going into 2025. As far as multifamily, looks like that spending will stay kind of flat or a minimal gain. Commercial, again, projections are to be pretty flat in 2025, industrial and institutional. So, and maybe this is because right now the difference in price between building and buying can be huge, especially in retail. Like building in retail now, you're often looking at $300 a square foot, and often you can buy at less than 100. So this mismatch is probably part of what's driving what might be less construction going forward. But again, a lot of this is compared to some really fat years over the past decade. So these changes really are kind of flattening out at the top. The question is what happens going forward from there? So what is this construction outlook? We've talked about some different views here. When we look at some of their costs going in, payroll is still one of the biggest costs. Non-residential construction payroll their payroll costs are still going up, meaning wages are still going up. And that's just due to demand in this sector for finding employees. It's one of the hardest things for builders is finding employees. I got a little map here that shows construction employment by state. Most of the country, construction employment has been growing. There's only a few losers out there. When we get into population trends, we'll see a lot of these losers showing up over and over again. The big two, New York and Pennsylvania. We actually see still increases in California's construction employment. The other losers, Colorado, Washington, Oregon, Minnesota, and North Dakota, some of the bigger winners where construction employment has been skyrocketing. Biggest are Arkansas, Oklahoma, Nevada. Even here in Wisconsin and Michigan, we're seeing some good changes and increases in construction employment. So what that means is there's still a lack of workers in these sectors, in these trade jobs, and still a strong employment outlook for people looking for jobs, still a struggle for builders looking for employees. We see here again when we compare March 2001 through March 2024, new hires have been pretty stable across the last decade, but have dropped off pretty sharply over the past year. When we look nationwide, job openings have also dropped off too. So although employers still struggle to find employees, it's not as bad as it has been. And this is a pretty cool chart here showing construction wage premium versus the rest of the private sector. Through 2000 to 2019, construction employees were making a 21.5% premium. Now, the last 4 years, that's dropped off, but it still is just under 19% at 18.9% premium. So still, people looking to work in the trades and work in the construction industry are still being paid significantly better than the rest of the population, although it's not quite as good as it was a few years ago. We talked about this a little earlier. Construction materials versus employee construction costs. Employee costs have stabilized where construction materials really shot up through 21 and 22. They dropped down just as sharply to get back to COVID time prices, and now have stabilized. So inputs besides labor have been quite volatile over the last few years, and maybe we'll start stabilizing here. Now, this is a really interesting graph because a lot of time people look at contractors and they're like, oh man, these guys are making a killing. Some of them are, and some really good ones are doing really well right now. But being a builder is a tough business. And what this next graph shows is that input costs have been going up faster than bid costs, meaning the contractors haven't been bidding up their prices as fast as input costs have been going up. But the good news for those people looking to invest and buy buildings or to build buildings is it has stabilized over the past year on both fronts. So part of what that does is it just starts to make it a little more predictable. Because going back to our story about our office building, when you can't even say how much it's going to cost to build a building, and where the change in the cost, our change went up over 100% over the course of 1 year while we were designing it. And when you see changes like that, it makes it hard to plan. So I think it's probably good for everybody, both builders and people who are hiring them, to see a little more stability. But with this, what happens with this cost squeeze is when we see these big changes in material costs and in prices and on bids, contractors got to be savvy in their contracting to lock in prices, or they can get pinched as these prices change and end up in the red, which is bad for them. And actually, it's bad for everybody, because right now, when we look at construction costs, if you lose more builders because they get squeezed, if somebody gets forced into bankruptcy because their bills are too high, that's one fewer builder, and that's just going to drive costs up again. So again, some of the volatility isn't really good unless you're somebody who's really in the know and able to really predict these changes and make big short-term gains off of hedging the volatility. But for most everybody else, and most people in real estate, really in commercial real estate, you make your money when you can predict the future with a little more certainty. So for a lot of us, as we start to see things stabilize, this will be a good thing. So here we're again looking at change in construction spending. The biggest increases between March of 23 and 24 is in manufacturing. And that again goes back to the onshoring and all the manufacturing that's been coming back to the US. That's happening for several reasons. One is predictability, but two, some of the countries where things had been offshored, particularly China, their economy has reached a point where they're not dirt cheap anymore. And so when you start looking at transportation costs, uncertainty of global transportation, it starts to push people to want to bring things back on shore. And that's what's happening. The other big winners here, highway and street construction went up 20%, education by 17%, power, including oil and gas, 13%. Non-residential went up 14%. So those are all still the bigger winners there. Important slowdowns is warehouse. And there's been a lot of building in warehouse, and it looks like warehouse is slowing down. Now, most of this warehouse construction have been huge warehouses for places like Amazon. The smaller warehouse space is still an interesting, because that kind of fits in, it overlaps warehouse and small manufacturing can kind of go in the same boat. An interesting one here when they talk about office. So I've seen this several times now where office gets combined with data centers, and probably because they use some of the same spaces in the past. But this is a really interesting one now because they are in total different trajectories, where if you look at pure data centers, especially with the growth of AI, and most of AI operates in data centers, the big computers that run the AI are data centers. And so while demand for data centers is still going up and has been strong like it has been in manufacturing, demand for office is shrinking. So when these two get combined, you're kind of taking a big winner and a big loser, and they cancel themselves out. So this just showed, still a 7% increase if you combine office and data centers. To me, that doesn't mean a whole lot because they're pulling in different directions. And at this point, they're apples and oranges, and they shouldn't be in the same bucket. But until everybody starts looking at a lot of this and pulling these out, we'll see a lot of that. So when you see these statistics, there's another good thing to look at. If we're looking at office and data centers, are they combined or have they been separated in that data? Some of the changes here, again, these are kind of all over the place, and I'm going to spin right through that. So really, for the summary here, medium-term outlook for construction, economic recovery should continue, but with sticky inflation and interest rates. And those two go together. As long as inflation stays higher and employment stays high, we're going to see interest rates stay high. And I think it's going back to 5% or lower anytime soon. Is not going to happen unless we have a huge crisis. And none of us want a huge crisis. So I think the more that when people start settling into 6 to 7% is a normal interest rate, that's where things are going to be. And then we can start seeing things start to become a little more predictable. Single family home building should continue recovering. This kind of goes with the housing shortage. As more of the millennials move into family age and middle life, we often, or many experts expect to see increased demand for single family housing. Multifamily, warehouse, and office could possibly see steep drops in construction as vacancies increase and costs decrease. That doesn't mean they're not a bad place to invest, but there's a lot of pressure for decreasing the amount of building. And this is interesting because there aren't many places in the country where if you drive around, you don't see a ton of apartments still being built. And so the question is, where does this tip over to where maybe this hot building slows down a little bit? And then, as we talked about before, data centers and manufacturing construction should remain hot. These are the hottest things in the construction industry right now. There's a lot of political things going on that you may hear a lot about, especially in the mainstream media, as far as infrastructure investment, the Jobs Act, the CHIPS Act, the Inflation Reduction Act. These could all give a boost to infrastructure, manufacturing, and power construction. But this is not going to happen overnight. Money will likely be slow to turn into construction and getting from the government through things being awarded. And the Buy America labor environmental strings could tie project starts up for years. So since, as we said, this is all a lot of political stuff here with the acts we were talking about entering into a presidential election. We're probably going to hear a lot about this stuff. Isn't going to be enough to change stuff. Probably not. I expect infinitely more, 10, 20 times more talk than actual action here. The action that is really available to make things happen without causing inflation is minimal. So there will probably be a lot more talk during the elections than there will be actually things going on. Other things to look for going forward, material costs and lead times to get materials should be getting better. There's still some question about electrical gear and electronics moving forward, and labor availability has resumed being the number one challenge for contractors. This challenge never went away. It's just that getting other materials has gotten easier while labor has still remained a big challenge. So our next slide here, population change by state. This is so important to keep track of because where people are moving and growing tend to do well. And some sectors will remain hotter than others. But growing population is good for real estate investors. Shrinking populations are bad. So the biggest growers are Texas, Florida, and South Carolina. This hasn't changed. This has been going on for a while. The biggest losers, New York, Pennsylvania, Illinois, California, and then some others, which would be Oregon, Louisiana, Hawaii. But these are trends that have been going on for a while. The second tier in biggest gains, still the Southeast has a lot, North Carolina, Tennessee, Georgia, but in the West, Utah, you guys know I love Utah, and Idaho, along with South Dakota. So everybody else is pretty flat, either small gains or a little bigger gains. The rest of the Midwest is kind of the next group in slower growing, which is kind of where the Midwest has always been, is slow and steady. When things are hot somewhere else, everybody forgets about the Midwest. When things aren't so great everywhere else, the Midwest keeps clicking along. For me, the biggest question will be, as a lot of industry starts being onshored, will this industry come back to the Midwest or will it go someplace else like the South? I know a lot of the Midwest, especially Ohio, has started seeing some of this coming back. And likely, I think we're going to see good times for the Midwest over the next decade, as long as we don't see a huge setback for the overall economy or something a really big recession. So moving on from there, on from population, let's look at projects that were bid over the past 5 years, going back to 2019. We still see these, this more looks at over the time of year. Most bids happen in the spring. They slow down going into the winter and then start picking up the first of the year. And this is kind of the seasonality of building, because in a lot of the country, it's hard to build in the winter time. So jobs get bid out in the spring and built through the summer. We got some Canada data here, which to me isn't that important. I don't think we have a whole lot of people listening to the show who are investing in Canada. If you are, reach out and tell us, say, hey, man, we're here in Canada. And that stuff's important. As we scroll on through, I'm just going to start wrapping up this show, but building use increases, looks like the biggest increases recently, education and retail. Retail's the big winner here. So here we're looking at, when we're comparing 2023 and 2024 year to date, U.S. building use projects. There are prominent increases in 2024. So big increases were educational, retail, and restaurant, as well as data centers were also up 18%. It's a smaller portion of the economy, so they have smaller little things here on the graph. Now, anybody in the Midwest, the amount of retail building in a lot of mid-sized Midwestern cities has been substantial. In Green Bay, the amount of retail building, there's been more in the last year, and I don't have data on this is personal impression, than the last 10 years. And so really a sector that looks like it's on the rise. The declining sectors, municipal, multi-residential or multifamily, and office. And it looks like warehouse started slowing down in 2024 too. And warehouse had just been on a tear. So warehouse construction, we've seen a few times here, continues to decline. Other decliners, medical, fire and police stations, and office, new building on office is down 46%. So as we said, office, the pain in office is not over. We haven't seen a total meltdown, but we're not done yet. So what does that mean? It means there may be more deals coming, and we should keep an eye out for these deals. In office, it's not a bad category. You just have to be very particular. You can't just go buy office unless you have money to sit on for a decade. And there is some pretty big private equity buying big city center, major metro office towers at a discount, but these haven't gone to severe discount because there's some big money out there that believes these will recover. So key takeaways here: certain verticals may appear underperforming in 2024, but in reality, they're merely normalizing after a period of unprecedented growth. Biggest one here, government offices and laboratories. So these may look like they're doing poorly, but they're actually just cooling off after being overly hot. Certain categories are setting an expected bottom before returning higher. Residential is the one there. So we should see residential doing well. And some other categories are expected to ramp up in the near term, having already passed through established lows. This is hotel, shopping, and amusement. Today's tide's not lifting all ships. It's a great analogy, but some things are looking like they're picking up where others aren't. So reshoring and national security mega projects should still be going up. Energy and electrification should still be going up. Civil projects should still be going up. But interest rate sensitive markets may still be going down. And this is one, it really depends on how a lot of perceptions are. There's so many people still holding out to do things, waiting for 5% interest rates. And those people will likely continue to wait. I, for one, don't think we're going back there, but it's a possibility. This one, I just wanted to hit this as one of our last slides. Project stress conditions. So these are the things, projects that are underway or even in the planning phase that are under stress. So the number one condition that is leading all stress projects is abandoned projects. And I guess we were part of that. We abandoned a project. I'm leaving that practice now, and actually it'll be this week. We can talk about that on another show, but they're going to reignite that project and do it a little differently. But abandonments are still high, and that's where projects just stop. Typically, this isn't like the 2009 where people just walked off of construction projects and they were half built. These typically are getting abandoned at a different point in construction. But there are quite a few projects still being abandoned. There are quite a few others being put on hold or are getting delayed at the bid phase. But there are still some projects being abandoned. And then the final one here, is build versus buy working against construction. It has to be. We talked about this where when you can buy retail centers at $100 a square foot that are quality centers, but to build a new one is $300 a square foot, there's definitely pressure there to buy existing rather than building new. So this will affect the construction industry going forward. But what does this mean, for those of us in the industry who are investors? I'm just laughing there because, I've been recording this. The sun went down and it got dark. And when I switched screens, I kind of slipped away into the dark and had to turn the lights on. So the joys of podcasting. Anyway, so, this is really kind of looking at what's going on in construction and how does construction affect us as investors in a couple ways. The big one is when we're looking to buy buildings, existing buildings, we're still in this place that existing buildings are the best deal because they cost so much less than building a building. The second place is what are construction costs for repositioning a building? And this can be significant. So if you're trying to build a big, there's like some old big warehouses for sale. And one of the great things being done is if you can find one of these big warehouses and then divvy it up into flex space and demise it into smaller units, these smaller units can lease at a lot higher prices. The question is, what's your remodeling cost to do this and how much construction work needs to be done? And I've seen projects that looked great, like they were going to work this way. Once we got them bid out, they didn't work so well. And the deals were let go because construction costs were still too high there. The construction costs still affect value add projects and really push for value add that doesn't require as much construction and is more where the value comes through repositioning and creativity somewhere else in the project. So what's the take home from this show? I think the big thing is we're starting to see construction costs stabilize. Material costs have definitely stabilized over the past several months. Cost of the big variable here is still construction workers. Construction worker wages are still rising, not at the rates they were. And this is still keeping construction prices high. And as long as the entire job market is tight, this is going to be a place that there's going to still be high demand. And right now, it's interesting. I've got two kids who are just, are finishing or finished high school in the past year, and there's still all this talk in high school about going to college. It's still a big push, and it's the education industry. What do you expect out of education? And this is not a dig on educators, but we do tend to see the world as being better through what we do. So I expect high schools to promote higher education. But the reality is, I get these flyers all the time and, from these colleges for my kids, and they're like, our graduating students make on average $55,000 a year. And they're promoting this, when there's kids who went through tech training programs in high school that are walking into jobs right out of high school or with like 6 months of training, especially the ones who already had some in high school. And by 6 months out of high school, they're making $70,000. And as they gain more certification and more experience, their wages are going up even more. And I've even seen ads recently for licensed HVAC techs, plumbers, electricians that are in six figures. And so construction prices are still going up, and if you got kids who are interested here, it's still a great place for kids coming out of high school. They're going to make a lot more money and they're going to make it a lot faster. And if they invest it well, I don't know if the college kids will ever catch up. There's still some data out there. And people love to talk about this. So they say, a 4-year college degree will give you an extra $1 million over your career. What people don't talk about is if you take out the highest earners, which are basically your doctors, your lawyers, your dentists, your architects, and some of your tech folk, that difference goes away. So going to college to get a college degree, unless that degree puts you on a very specific path towards a higher earning job, it does not translate into higher wages versus the wages that are available in the trades right now. So that's just from dad of kids heading to college right now. But, what this means is I don't think construction prices for construction employees are going to come down anytime soon. That's going to stay. They're going to keep that premium, and it's going to continue to be a big factor if you're looking at real estate investments that involve any construction, is really digging into what those construction costs are and how well are they understood. Are these projects bid out and under contract, or are they still projections? Those are key questions to ask. So I hope this has been some value. When I saw this presentation, I looked at it several times and I just thought there was so much interesting stuff there that I wanted to share it. We're heading into a time here that could see some just incredible deals in real estate. There's a lot of tepid investors out there who haven't been diving in, and a lot of questions. I've had a lot more people talking about wanting to start, but haven't been starting, and they still have concerns. So it's always good to get started. If you're looking at investing in real estate and you have questions, reach out. I'd be more than happy to talk to you and see if I can help you along your journey and answer those questions. You can go to the Surgeon Syndicate website and schedule a call there. Reach out. Let's talk. Let's get you going. And on that, we're going to wrap up this show. So thank you for joining us on Surgeon Syndicate, and we look forward to seeing you next time.
This has been an episode of Surgeon Syndicate. If you got value from this episode, other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.